Greetings, greetings, greetings. In a world where COVID-19 is upon us, we probably need to diversify. Diversification is a process of allocating resources. You allocate capital to different assets, to different stocks, to different investments in order to reduce their exposure to risk. That's diversification. Why exposure to risk? Because an asset might go up in terms of profit or growth. You are going to be happy when that happens, but the assets can equally go down. So hence why you need to diversify across different assets. So that is diversification. Why do we even diversify in the first place? We diversify in the first place because, as I mentioned earlier on, due to the different returns or profits or growth potentials of different assets, and because assets move in different directions, they are never uniform. That's the main reason why we should be diversifying. Because if you only have one company or one stock, it goes to zero, you've lost. If it goes to 100, 200, you're happy. So I mentioned also on the correlation already. To move on straight away, how is diversification used? Before I speak on how diversification is used, let me speak about the different risks. You only have two different risks. Because in my definition, I said you want to reduce your exposure to a particular asset. So in terms of risk, you have two different kinds of risk. You've got the systematic risk and the unsystematic risk. I repeat, systematic and unsystematic risk. Systematic risk is the risk that we call market risk, and it's undiversifiable risk, like the stock market, like probably what has happened to us during this COVID era, whereby everything went down. And I've not said all assets, but most of the assets, because you have other assets like gold that does well in periods like this. But when we talk about this diversification now, it's most of the assets. We all know what has happened in our economy in terms of COVID-19. So that means that's the non-diversifiable kind of risk where everything goes down. That is systematic risk. Even also during Brexit, that also happened. The second kind of risk is on systematic risk or diversifiable risk or firm-specific risk or stock, particular stock, the risk of that company or that firm. That risk, you can diversify that risk because it does not depend on the market. That's where you can diversify that risk by selecting different investments. I'm going to move along straight away quickly to speak on the different types of diversification. You have various types, but I'll limit it to about 5 based on this conversation that is principally used. You've got sector. You can diversify according to different sectors. Think of pharmaceutical, industrial, financials. You could diversify. You could also diversify according to geography, going to different geographies in terms of across the globe, across different countries, across different boundaries. You can also diversify within different assets, as I first mentioned. You could also do currency diversification, which goes with your geographic diversification. And obviously, you can diversify according to the different stocks and shares, which are the instruments. That is how those are the different types of diversification. You could do lots and lots of things. You could also diversify by investing across different kinds of business, private equity. You could also diversify, but it's just about understanding the concept. And I call this probably diversification 101. How do we therefore diversify? You simply diversify by buying more and more of a particular share or more and more investment or company, but this time around not one type. You buy several types. This means that if one of those shares, the stock or the investment or your private equity is going up, the other might be coming down. So that is the meaning. That's why you buy a lot of shares. But according to the modern portfolio theory and according to different investment researches that have been done, you can only diversify that much. So if you diversify between, say you add stocks and shares or company between 20 and 30, and I'll keep it at 20, you reduce your risk of that portfolio by 20%. You reduce your risk by 20%. So from the next 20 companies or stocks to the next 1,000, you can only reduce that risk by 0.8%. So you see the graph goes like this. Over time, I'm going to be drawing and sketching behind so you can see the graph where it starts there and then it goes down, and you can only diversify that much. So you cannot really diversify right down to zero per se. And even if you buy 1,000 stocks or 1,000 different companies, you can only diversify that much. There are other people, other school of thought that they think that diversification is not even going to exist. That's another conversation for another day. Now, what are the importance of diversification? How does it benefit you? What are some of the benefits of diversifying your investment portfolio? There are several and numerous benefits that I'm just going to touch on, probably one or two, three, and then that is the core matter of diversification at the elementary level and trying to build up into your investment and what you are trying to do. So some of the benefits are you reduce your volatility, you reduce your risk. I've mentioned that. Risk is part of life. So does an investment. You cannot be wanting to invest without diversifying your risk. And by you diversifying your risk, it means that there is a potential for you to have increased profits, increased capital growth. It is very important for you to note that by you diversifying, this is already the third point, by you diversifying your portfolio, you are matching your attitude to risk to your different investments. Now, attitude to risk is a conversation that I'm going to talk about sooner or later, because you have risk profile, which is low, medium, and high risk. So it's also very important that we note that. I've also mentioned by you diversifying, you are diversifying in assets or investments or businesses that are not correlated. So if one profit or one company is going up, the other might potentially be going down. So those are some of the importance or the benefits of diversification, and this is the basic and elementary level way, and this is where you build up, because fundamentally this is what we have in terms of diversification, and every other block moves from here thereon. So that's diversification in the nutshell.